Good morning and welcome to another episode installment of Axiom. My name is Albert Jansen van Vieren and I'm coming to you live from Johannesburg. I'm back in the office, so we're privileged to be back in the office and have social distancing, which is great. So beautiful, sunny winter's morning here in Johannesburg, and welcome to all of you. I see we have some people who dialed in from Mauritius, some people who dialed in from Paris, and some from Ghana and from the UAE. So welcome to all of you on this Axiom presentation webinar today. Really looking forward to today, where we're going to have André Curtin sharing with us. André is a friend of Andile. We've worked with him in the past a lot in Africa, and he's done a lot of our in-house ACI training to our people as well. He's well known on the continent, so really looking forward to that as well. Just a bit of just the agenda for today. So in a couple of minutes, I'm going to hand over to André, and he's going to talk for about 40 minutes or so. So at any point during the webinar, I want to encourage you to ask questions, especially today. Ask questions, share even your thoughts. It doesn't even have to be a question, but in the middle, in the bottom, in your screen, you would see there's a Q&A button. So we're not going to take live questions while André is talking. But throughout the session, you can submit a question, submit your thoughts. And at the end, we're going to open it up for Q&A, and André is going to answer your questions and share some thoughts. So I really want to encourage you to just share with us that today. And André, I'm then welcoming you to the session.
Thanks so much, Albert.
Yeah, it's great to have you, André. Like I said, you're a friend of Andile. We've worked with you in the past quite a bit, and you've trained our people. We've trained together in Africa with Richard as well. But tell us a bit more for the audience who don't know you, just a bit of a background of your professional career and where you come from.
Okay, thanks. I got into banking through a need to buy a property. Banks offered low interest rate mortgages, so I walked into the personnel division of Nedbank, and I was very fortunate to be placed in the Treasury, and for a year worked in the operations environment. Yeah. And then was offered an opportunity to be a junior money market dealer. And so I spent a total of 9 years at Nedbank, and I think one of the most beneficial things that I experienced in that process was that we went through our democratic transition in South Africa, and as a result, our financial markets broadened significantly. And one of the things that the bank needed to do was to involve themselves in offering customer solutions to manage both exchange rate and interest rate risk. And so the bank asked me to be involved in setting up an interest rate derivative desk for them to trade swaps, FRAs, and interest rate futures. And I sat next to a young man who traded the currency options desk, so I was able to help him and he was able to help me. And in that process, obviously, was able to touch on a lot of different markets, but in that process also got involved in teaching people how to apply these products. So spent time with customers and clients, and that really led me to see the potential there was for me to become part of a training fraternity, people that are out there educating people about the products. And so for the last 20 years, I had a period where I was involved in teaching farmers about agri-derivatives, was involved in the interdealer broking space. But for the last 20 years, I've been in front of people teaching them about these products, preparing them to write benchmark qualifications, and also helping to educate the market around different financial products.
So André, am I correct in saying you were at the forefront, kind of seeing the evolution of the financial markets, especially in South Africa, going just from into the derivative space and building that out? You were quite instrumental at certain banks that you worked to build that out. So you've seen that evolution of the market of South Africa over time.
Yeah, absolutely. I mean, I think one of the most incredible experiences for me was to see the transition of our commercial farming sector, which was basically reliant on government setting price, and then engaging with the farmers and setting up contracts for all the grains and oilseeds in South Africa. So maize, wheat, sorghum, and sunflower predominantly, and allowing them to see that they didn't need government to set price, that if we could create a marketplace where they could determine price for future dates. They were able to then decide on their plantings, on which products were in demand globally. And, you know, that whole process for me was amazing, because I think there's a dearth of that on the continent, that we don't have enough people who are actually driving the price in their local currency. Most of the products obviously trade on the international markets, but yeah, that was for me one of the more exciting involvements that I had.
Yeah, I'm looking forward to that. And of course, we mentioned South Africa, but today's talk is not about South Africa. It's about the African continent. And I think what you're going to do today is refer back to the things that we've learned in South Africa, but in parallels, draw a picture between what's going on in Africa. One of the things for people that are attending today, one of the things we are going to, we want some interaction from you, is to use polls. It just helps with the webinar for André as well, to get a view so we've got a couple of, as he talks, a couple of polls that's going to come through. A quick one, just to give André a view of his audience. So when I spoke to André, a big thing for André was he's used to classroom training. He loves interaction with the people. He loves talking to and getting feedback from them. So just to help him, give him a bit of a view of his audience, we're just asking this question of, where do you see yourself in the financial market? I'm just going to give a couple of seconds for you to vote. And then André, just show you those results. And then we're going to hand over to you. Then you can take us through what you have prepared. I'm really looking forward to that. I'm just going to give maybe like 5 more seconds for us to vote. Not everyone has voted yet. And that will just give you a bit of an idea of your audience. So let me share that result. So you only have one trader today, André. You're going to have a couple of people in a risk space, and then people that's none of the above, completely outside of financial markets. But I think it just gives you a bit of idea of your audience that you're going to talk to today. And at this point, André, I'm going to hand over to you. And yeah, we can then, as I said earlier, please, if you can submit questions, even submit thoughts. If you agree with what André said, even if you don't agree with what André said, please submit your thoughts. We encourage that as well. And then we'll have some discussion at the end. So André, over to you.
Thank you. Thanks, Albert. Okay. Let me just get my slides up. Okay. Let me just see if I can. Right. The agenda that we have for today is.
Sorry to interfere there, André. Yes. On our side, we're not seeing your slide. We're just seeing so maybe if you can just pull out the cable that's projecting to the other screen, then we'll be able to see your slides.
Okay. Can you see them now?
Just end your show. Sorry about this, guys, but this is my role as a facilitator to help on the other side. As you know, with these webinars not being in the same room, we always have these technical issues. So just bear a couple of seconds with us. But André, just try share that again. If you just click here on the top left on the use slideshow.
Just see now.
Fun times of technology. I'm sure all of you in the past couple of weeks in lockdown, we've been, there you go. Now we can see that. So André, thanks for that.
Thank you. Let's just see if we can go forward here. Oh, no. Albert.
Hey, André, yes, we can see you go forward.
Okay, magic. All right, so you can see me.
We can't see you. I don't know if your video is on, but we can see your slides.
Okay, let me just see if I can do the video as well.
This is good. You go for it.
Yeah, I think even if we can't see me, I'm quite happy just to go through what we have on the slides. Just to go back to the agenda then, just click on here. we're going to have a look at the financial markets framework, and I think that's important because basically we need to recognize that financial markets hang together. There's no single market that operates in isolation. In other words, the markets that we're going to speak about today are those that are the fixed income market, the bond market, but basically recognizing that that doesn't operate in isolation. So if we look at the financial markets as a whole, the area that we're going to focus on today is our interest-bearing markets or fixed income market. But you can see the connectivity that that has to derivatives, to money market, and I would say also very closely to the foreign exchange market because of foreign participation in the markets. When we talk about the bond market as such, the market is no longer reliant on a fixed location. And really, when we talk about the financial markets today, we're really speaking about a global market, which is a global village, where everybody is connected to each other through a network of computer terminals, and that it doesn't matter who you are, you're able to look at price, see what's happening with price. And the market generally is dominated by government issues, and those government issues in developing economies are becoming more and more dominant as far as investment goes. People are looking more and more to yield in those environments, and we're going to speak a little bit about that. So identifying the participants in the market, we would see governments as issuers and corporate borrowers. And just to say as well, that government is a large investor in government bonds simply because they manage large pension funds on behalf of people that work for government. So indirectly, government, although they're an issuer as well, they can also be an investor in the market. Banks have exposure to long-term interest rates. Banks also, under reserve requirements that are prescribed by the central banks, have to hold a certain percentage of deposits that they take in government securities. So they are natural investors in bonds. And then you and I, through our pension funds, through direct investment, through collective investment schemes, are part of the broader class of investors. But I would say that mainly when we talk about large investors in that space, it would be your large insurers, particularly those that do assurance, like long-term life insurance and insurance companies that are involved in the market for annuities and for endowments. And then your fund managers, those people that look after money that's invested by corporates, by individuals, where they are considered skilled individuals who are able to then take the money and pool it and then look at different asset classes. And one of the major asset classes that a lot of fund managers invest in is the government bond or fixed income market. Our corporate borrowers, a lot of corporates who want access to capital generally use the equity market to raise capital, but after they've done an issue, an IPO, and they need more capital, either by doing a rights issue or in this environment that we find ourselves now, where interest rates are so low, many corporate borrowers are issuing bonds because the demand for yield is so strong. If one looks at the developed world, a 10-year bond might offer you 0.25% or 0.5% in return. And so corporate borrowers are able to issue bonds at very low yields at the moment. So realistically, it's very cheap to borrow money. How does the bond market operate? Well, generally, like any formal financial market, it provides a regulated environment, and that's really for the raising of capital through the primary issue of bonds. So just like an equity market where someone who wants to list a company would go, as long as they meet the criteria that are prescribed, they are able to list a company. And in the same way, if someone wants to issue a bond, there are certain requirements. Most countries would have a requirement that a company that is looking to raise capital through the issuing of a bond must be a listed company, and they should have a credit rating. And then the market also provides a secure environment for the trading of those bonds. So in other words, the bonds are issued by the person looking to raise capital, and then there is a platform or a market where those bonds can then move between buyer and seller. And most markets would provide some form of protection for investors, and that would normally be under the rules of the exchange that is used as the platform for trading those bonds. When we look at the market and how the prices are derived in the market, there are two clearly structured ways in which markets would be presenting price. And the one is a quote-driven market. And a quote-driven market is where, as the market opens each morning, there would be both a bid and offer price for the bonds in that market. And that is because the issuer of the bond, and in most countries the primary issuer is government, and when I say government, really most countries operate an arm of government that is a financing arm, like the UK would have what they call the Debt Management Office, the DMO. And the DMO would operate on the basis of acting in the needs of government for the issuance of securities. In South Africa, we refer to it as National Treasury. So that's the financing arm of government, an independent structure within government that is responsible for their issuance or borrowing program. And they appoint primary dealers, and those primary dealers would attend an auction when government is issuing more bonds, and they are then obliged to make prices in the market. So you would always see a bid and an offer in a quote-driven market. And then an order-driven market would be one where bids and offers appear as buyers and sellers come to an organized exchange and ask a member of the exchange to act on their behalf. And that generally is how most equity markets work in the developing world, in developing markets. In other words, stock exchange like the Johannesburg Stock Exchange would operate on an order-driven basis. There are no primary dealers appointed to show bids and offers for our shares. So buyers and sellers would put bids and offers on. So where there are no offers, there might be buyers, but there's no one selling. In an order-driven market, that would not be the case in a quote-driven market. Okay, the central bank, or what we would call the Reserve Bank in South Africa, have a very important role to play because they are directed by our National Treasury in South Africa to do the auction of the bonds as required. And so they conduct a weekly auction. And the role of the central bank really is to encourage an active market. And to do that, they must encourage an active repo market. And I'm going to speak about repo when we go through some of the topics later on. They also encourage an active secondary market for bonds. And they can act in the market to influence money supply. I know recently in the media, we have heard that our governor, during April and May, the central bank was very active in buying government securities. In fact, I think in April they bought something like 11 billion, and in May they bought 20 billion rands worth of bonds in our market. And the primary reason for that was to stimulate the economy by putting money into the market. So when government buys bonds, what they're doing is they're creating money for the money market. So in effect, pumping money into the system. And that's not an unusual thing. I mean, we've heard about the ongoing purchase of bonds by the Federal Reserve and by the European Central Bank to create liquidity. And that was an ongoing process after the 2009 crisis, that credit crunch, subprime crisis that we went through. A lot of economies began to contract during that period, and to stimulate the economies, they pumped a lot of cash, and they did that through open market operations, and that's what they refer to it as, open market operations. I think, Albert, what we can do then is just poll to see who should drive the development of the bond market in a country. If you can just pop up that poll. Thanks.
Yeah, so André, I'm going to give it a couple of, let's say about 10 more seconds or so for people to vote. I can see quite a couple of answers coming through there. And then, yeah, I'll make the results available to you, and you can just talk us through that. So
sure,
maybe about five or so more seconds.
Magic. Okay. I think we're seeing that the majority of people are voting. Well, 50% of the people in the poll are looking at the central bank as the driver, and then that's really looking at the rest of them. It's evenly spread between government, banks, and large institutions. Okay, so I can share the results. Thanks very much, Albert. Okay, I think personally that there shouldn't be a single institution that is responsible for the development of the bond market. I believe it should be a collective exercise. But the one thing I will say, however, is that my experience on the continent and in developing markets where there is limited activity, even although there might be bonds in issue where there's limited activity, that the reliance on the regulators or government to drive the process of making or seeing an active bond market materialize is unrealistic. I think that the responsibilities of the central bank primarily is to make sure that the banking system remains stable and that there's confidence in the banking system, and that they have a look at the health of banks, that the central bank remains autonomous from government, but that they work in consort with the markets to stimulate economic growth. But I think really the market as a whole, and that involves all the participants, are responsible for driving the development of the market. My experience in South Africa was one where the market needed to change, and this was in the early 1990s, and that really happened because people realized that the floor was not effective. A centralized point where people met to trade bonds was not optimal for developing our market, and that we needed a far broader participation in the market. And that led to the market changing the way that it showed prices, and the way that it developed the market was to look at all the players, to bring them together, and then to discuss what they believed was necessary to drive the market forward. And it's never easy, because obviously what you're doing is you're asking people to participate in a process that might create more work for them, that would require greater surveillance, and oversight of the market to make sure that there's no exploitation of investors. But I believe with good intention that everybody participating would make a difference. Okay, so let's then have a look at what we need for a vibrant market. So why do we need a vibrant bond market? I mean, why is it important? I think one of the key things for me is that it creates an environment where there's access to capital in local currency. In other words, a company in Nigeria that's looking to raise money is looking to raise Naira And so they would issue a bond in Naira as a corporate, as long as they meet the requirements. The government in Nigeria wants to raise bonds. It's going to raise bond or raise capital. It's going to issue a bond in Naira for the purpose of developing the local economy through the use of fiscal policy. And also it gives investors a vehicle for local and foreign fund managers as well. In other words, you've got a lot of money coming into the investment houses, the fund managers, the pension funds, and they need vehicles to be able to invest. Foreign fund managers looking to diversify, looking for yield, are looking for bonds in different investment destinations. And I think another thing that it's very valuable for is that it forces governments to pursue a deliberate inflation targeting policy, a credible one. And when we talk about the different kinds of bonds, you will see that one of the key bonds that government issues today are your inflation-linked bonds. It establishes a credible yield curve. Just going back to the inflation targeting, I mean, we know in South Africa that government has set a target for inflation between 2% and 6%, and that they use monetary policy primarily to try and keep our inflation rate within that range. In Europe, I know they're trying to get inflation up above 1.5% and to try and get it around 2%. And I know in a lot of developed markets, we've seen very, very low inflation. And there's been a drive to try and stimulate the economies. It's not to create hyper, but certainly to create an environment where inflation reflects growth in the economy. But I think establishing a credible yield curve, and I mean, it's very difficult for me because I don't want to pick on a particular market and highlight the fact of, or highlight the inefficiencies that I've seen in those markets. But a while ago, I did some work, and it must be over 10 years ago now, that I initially went into the Kenyan market and did some training on fixed income. And I had a look at their bonds in issue at the time. And I really saw a yield curve that reflected very different yields across the yield curve. And when I questioned the people in the markets about why the 10-year was trading at 7% and the 5-year was trading at 15%, and that they had this massive hump in the yield curve, the response I got was that the 10-year hasn't traded for at least 18 months. So the last time it traded was at 7, and I'm just using a number. And the 5-year was trading at the moment, but there was very patchy activity in the market, and in fact their bonds didn't trade very actively. And so very difficult when you don't have active bonds trading to establish a credible yield curve. And a yield curve is very important because when we're looking to issue, we need to know, I mean, if government's looking to issue in the 10-year, the easiest way for them to know where the market is to look at where the 10-year is trading. But if it's not trading, then at what yield should they be issuing? That's where there's a challenge. And I think the next bullet, giving credibility to the country's financial system, I think that's an important thing as well, that the better the bond market is, the easier it is to access the market, the more credibility it gives to the market. I mean, if you just look at what's happened here, we've gone through a downgrade, we've entered into the COVID a situation as the rest of the world has. And yet, in the last 3 weeks, our currency has strengthened. There's been huge demand for our bonds. Our bonds have, and particularly the Bellwether 186 bond, which is in the 10-year area, that bond has gone up in price by about 14% in the last month, which tells me that although we've gone through a downgrade and we have this COVID hanging over us, that in fact people are looking at buying our bonds because we have a very credible financial system. And long-term derivatives. If you don't have an active bond market, difficult to establish where yield should be, then very difficult to develop a long-term interest rate derivative market. And really the need for swaps and FRAs and those interest rate derivatives is a very real need within the banking sector, because banks have to hedge their interest rate exposure. Remember, for a bank, their stock in trade is money, and the price of money is an interest rate. And so the interest rate at which they buy money and the interest rate at which they sell money is influenced by a number of different factors. And so banks, where they see that their position is one that needs to be changed, one of the easiest ways to do that is to apply a derivative instrument. And active engagement between market participants and the regulators towards a common goal. I mean, I think that's very important, that there must be open communication, that there's got to be interaction between people in the market. So how do we achieve it? We can look at other successful developing markets which have an active bond market. I mean, I know with the work that I did in Nigeria, I first went there in about 2004 or 5 and spoke to the stockbroking fraternity, got to do a presentation on fixed income over a 3-day period for probably 80 or 90 market participants, and shared my experiences of the South African market without appearing boastful or bragging. I think helped to create some momentum there. In Ghana, in Kenya, I've done the same thing. I run fixed income and repo workshops, and really looked at the South African market as a model in the way that we've achieved best practice. And I think it's important to establish like a working committee of people from different sectors within your market who have an interest to see a vibrant bond market develop, so that they can drive the initiatives. And strong engagement between market participants and regulators to work towards a common goal. You know, just from my personal experience, when I started the interest rate derivative desk at Nedbank, or should I say, I was the trader sitting on the desk. I mean, there were a lot of people behind the scenes developing the software that I needed and the systems that we were going to work with. One of the primary things that I did was to get together with other people at the other banks and talk about what they'd been doing, how we could help each other by making markets. And very often management are reticent in getting active because they say, well, we want to see an active market before we actually start to participate. Because, you know, we could lose a lot of money by hanging ourselves out there and quoting prices. And so it's almost like the chicken and egg scenario, you know, what comes first? But actually by getting involved in the market, you establish credibility. By being an institution that is seen as a forerunner, as a driver of the initiatives that need a market to develop, that is an excellent way of doing things. So engagement between market participants, and then taking baby steps, you know, moving towards international best practice. Is important, that we cannot simply leap in at the top end and when it doesn't work say, well, it's not working. I think the steps have to be small in getting there. And then one of the key things that I've seen benefit our market, and something which the drum that I've beaten on the continent, is that we don't want to follow the American model or the British model or any of the models in the developed market where they have vibrant bond futures. And so when people express a view as speculators, they use the futures market rather than the physical market. We don't have a well-developed futures market here, and many developing markets don't have futures markets. The bond market, to be vibrant and active, must not have 100 bonds in issue, but that slowly there's a consolidation of the bonds in issue, and those bonds are replaced by a few bonds where they develop a deep issue. In other words, single bonds across the yield curve where there are billions in issue in each of those bonds, so that active trading of both buying and selling bonds becomes a reality. And so following the South African model is that when an auction happens, that government is not reissuing new bonds, as in new issues, every time they issue at the auction, but that they are tapping into the existing issue. So, for example, the 10-year, they may have an auction of another 500 million of the 10-year at the auction on Friday. So they are increasing the size of each auction, almost like a rights issue every time the auction happens. And so it's creating depth across the yield curve for the bonds that are in issue. Encouraging an active two-way market, as I said. How does that happen? Well, in a lot of markets, there are brokers, and those brokers bring buyer and seller together, and they are active in encouraging buyers and sellers to show them bids and offers, particularly in markets where, even if there is a quote-driven market, that there is depth in the market, both sides, both buyers and sellers, active buyers, active sellers, and then developing an active repo market. I think one of the catalysts as well, and I've seen this in the market in Ghana, is that through education and an understanding of how these products work across the spectrum. So we're not just talking specifically to people that work in the dealing rooms or people that work in the central bank, but to engage people across all the different financial market participant institutions in educating them on the fixed income market. So taking them into the deep dive of what we mean by duration and modified duration and how the markets work, really moving towards an environment where people understand the products. So it's a process, but I believe a very valuable process. And to be honest, I've done work in the Middle East. I'm starting to see a lot of institutions that are buying bonds issued by governments in the Middle East today. Sukuk is becoming a big thing where governments in the Middle East are needing to raise capital so that they can continue to engage in capital projects as government and no longer necessarily only relying on the revenue that comes from the oil that they produce, or the gas that they produce, but looking at other ways of raising capital. And so there seems to be a strong move to develop the fixed income markets in the Middle East as well. Okay, I don't know that I want to spend too much time looking at the bond characteristics, but just to briefly go through them, but I'd really like to talk more about the repo market. So just recognizing that a bond, when it is issued at a nominal or face value, and that is the amount on which the interest is paid. So if I'm buying a bond, the bond's coupon will be paid based on the face value of the bond that I bought. And the value that I pay for the bond would be determined by market forces. The term to maturity on a bond would be the amount of time that the issuer agrees to meet the conditions of that bond. When a bond trades in the market, it trades at a yield to maturity or as a price. And I mean, I know that in America, they trade on price. In the UK, in South Africa, we followed the UK model. We trade bonds on a yield to maturity. And the yield to maturity is generally the interest rate that reflects the demand for that bond and the supply of that bond in the market. So yields going up means that there are more sellers than buyers. Yields going down means that there are more buyers than sellers. An inverse relationship between the price of a bond and its yield. And the required yield really is the yield that would persuade investors to invest in the bond. And it reflects the current market yields. And I must say this though, where government is looking to issue into an illiquid, inactive market, they are going to pay far more to borrow money than if they were issuing into an active market. So for example, people might be happy to earn a yield of 15% for 5 years, but knowing that it would be difficult for them to sell the bond if they buy it, they're going to ask for a premium. They're going to want a return of, say, 17.5% on that bond. And so governments generally end up spending a lot of money to raise capital. In other words, the cost of borrowing is increased simply because there's an ineffective or illiquid market. And so by encouraging an active market, what they're doing is they're bringing down the cost of their funding. Embedded options, that's a fairly common add-on to a bond in the corporate space, where corporates that issue bonds generally issue them where they are looking to give the investor the opportunity to convert that bond into equity. Quite unusual to find governments issuing bonds that have an option to call the bond early, but it's not unheard of. I remember there was an issue in Nigeria a while ago where government called the bond early and replaced that bond with a new issue, but it's not something fairly common. The yield price relationship I've spoken about. Bonds can trade either at a discount or a premium. Discount would be a bond where the yield trades above where the coupon is, and the premium bond would be where the yield trades below the coupon. Price quote in South Africa, we quote price bonds or trade bonds on a yield. In America, they trade it as a price. I think if one has a look at that, one can see that a bond that is trading at 97.25 is really saying it's trading at 97.25% of its face value. And so a bond with a face value of 100 million rand would trade at a price of 972 rand 500. And as I said, in South Africa, we trade bonds on a yield to maturity. The common kinds of bonds that are issued, zero coupons, those are mainly issued by government where they trade at a discount. In other words, government might agree to pay back R1 billion in 10 years' time, but today through the issue of the bond, they raise 500 million, but during the life of the bond, they pay no interest. And fairly common for governments in the developing market where there's active markets to issue zeros. Fixed coupon bonds, those are the most common, where government agrees to pay a fixed return either semi-annually or annually. Floating rate notes, those are issued by corporates, and they are usually issued where the coupon is linked to a 3-month benchmark. In London, they have LIBOR. In South Africa, we have what's called JIBAR. So, and it's usually issued with a spread over the JIBAR. I will say this, however, one of the other weaknesses in some developing markets is that they have done very little to develop a credible market benchmark for the short term. In other words, having an interest rate on which we can benchmark the issuing of bonds or benchmark a derivative contract like an FRA or an interest rate swap. And I think one of the things that we really need to see happen is for the central banks, and there seems to be an initiative driven by the Bank for International Settlements to get central banks to develop a stable, credible market benchmark for their currency. Inflation-linked bonds, I mentioned earlier on, where government pays a coupon linked to the inflation rate. And in a sense, that also encourages governments to maintain a relatively healthy inflation rate. And then euro bonds, those are bonds that are issued in currencies other than the domestic currency in foreign markets. And a lot of developing markets issue euro bonds for the purpose of raising capital to help with their currency reserves. I know Ghana issued one a while ago. Egypt has issued one. Egyptian foreign exchange reserves have plummeted during the COVID because obviously Egypt as a country relies very heavily on tourism, and their reserves have taken a severe knock. So under the underwriting of the IMF, Egypt was recently able to issue a $5 billion bond to boost their reserves. And there were investors that wanted those bonds. In fact, it was oversubscribed. Just like the Ghanaian issue a number of years ago, Ghanaian government was looking to raise $750 million. They ended up issuing bonds with over $1.2 billion because of the demand. I think what we recognize then, and I'm encouraged by that, is that people understand the political challenges of the continent. They understand where the risks are, and they are happy to find products to invest in. We just need to create them, and bonds are one of those products. I want to talk very briefly about the settlement process, because I think this is one of the key things that we need to recognize in our markets, is that investors want to be involved in an environment where the settlement process is secure. In other words, where they know that when they buy a bond, when they pay, the bond will be in their name. Or if they're selling a bond, that they will receive the proceeds of the sale of that bond. And that is a very important process in creating credibility in a fixed income market in a country. Looking at South Africa, we had a very unhealthy system of settlement. Settlement was done with physical delivery until the 1990s. That meant you had to sign a transfer deed. That settlement was only done at least 2 weeks away from the deal date. It was only every second Thursday that settlement would happen. And that was not a very favorable environment for foreign investors. And so there was very little participation by foreign investors. But the government had instituted a law that forced banks and pension funds to hold government bonds as part of their investment portfolio. And so they didn't really worry that there weren't too many foreign investors. But as we've moved towards our democracy, there were 3 critical changes that were recommended by the World Bank. Firstly, we had to dematerialize. In other words, bonds were no longer going to be transferred through physical delivery, that bonds would be immobilized or dematerialized. In other words, they would be held on an electronic register, that there was a need to shorten the settlement period, and that they had to create an environment where there was good price discovery. So today, we have a market which has moved from open outcry to an electronic exchange traded platform operated by Straight and the JSE. Membership, you still have to work through a member firm, but membership is open to everybody as long as they meet the requirements of the exchange. So it's no longer the domain of stockbrokers as it was previously. As long as you are a South African business, a company, individuals can't become members, and you meet the capital requirements as prescribed by the exchange, you can become a member of our exchange. There's no remote membership yet, so foreigners cannot be members, although they can if they have a local operation. So JP Morgan here could be a member of our exchange because they have an operation in South Africa. Although they have a trading platform, electronic trading platform, what we would call an automated trading system at the JSE, it's still very much a market which is dominated by the large institutions through a broker network, and the banks are the biggest players, both locally and internationally. So the IDBs still drive that market as far as price goes. And so I think maybe, Albert, what we can do is we could poll the second question about which of the market participants do you believe would be the biggest players in our local market.
Give it a couple more seconds, André. I think while we wait for the results to come in, I'm going to just throw a question out to you here. And it's, I love what you're taking us through from the history of the South African market. And I don't know if you're going to touch on it, but is it something that you would say, well, that's a good model maybe to be replicated in other developing countries? Or as everything in life, we can learn from our predecessors, and you can skip through their mistakes, and there's a better way of doing it, and we can just learn and actually just apply something new completely to in a developing market. So I don't know if that's something you're going to touch on, but it's just my thoughts now.
Yeah, thanks, Albert.
Okay, I'm going to show the results then.
Thank you. Excellent. Right, so when we look at that, we see that the view of the participants is that both local and foreign institutions have quite a strong weighting in who the biggest players are. That central banks and brokers also play a role as well, but a far smaller role. I would say that realistically, based on the holdings that we see in our markets, that foreign institutions are big players, that there's no longer dominance by the local asset managers or funds, and that they are very active participants. So, and that is really facilitated by the fact that the interdealer brokers that are active in our market touch both the London market, which draws on a massive amount of banks that are available, and the need for foreign participants is very important. We need to attract those people into our market. That the local institutions don't have the muscle to move the markets as easily as they did in the past, or that they do currently. And so, yeah, although the brokers are not or never do take positions, they certainly have a role to play in bringing a broad spectrum of people into the markets. And the brokers that I'm speaking of are ICAP, which have a presence globally, ContiCap, Cantor Fitzgerald's of the world, the large interdealer brokers that have both a local and an international presence. I think what Albert mentioned earlier on, which I think is very valuable, is the need to look at how do we get our markets to the point where they are starting to act or begin to be more active. Do we look at South Africa and say, is South Africa the model to follow? Do we look at the London market? Do we look at the New York market? Who do we rely on to help us drive this process forward? Where do we start? I think one of the key things to recognize is that the technology that's needed to make a market operate optimally is not something which is difficult to establish. In other words, to create a platform for presenting of price and volume, to create an environment where we can have what we call delivery versus payment, where as a person delivers their security, they receive payment for that security. Architecture exists in various forms, and I think Andile's role in establishing that and motivating the need for a healthy DVP environment is critical. But I think what is important is to recognize the need for the regulators to step back and to allow the markets to operate optimally. I spent some time working with the regulators in Angola while they were busy looking at reintroducing the Kwanza as a currency. And one of the concerns that they had was that they were worried that the Kwanza would depreciate because people would speculate in the currency and cause it to weaken. And I said to them, you know, I think maybe the misconception of a lot of governments and regulators is the distrust of foreigners in how they're going to participate in their markets. And I said to them, guys, realize this, the market is looking for yield and we offer yield. The market is looking for commodities and we have very strong commodity markets on the continent. What we've got to create is an efficient environment where they have confidence to come and deal in our markets because they know they're going to get value and they're going to get settlement. And that entry and exit in the market is relaxed and free, that people can come in and trade markets comfortably, that the oversight of those markets by the regulators keeps an eye on the fact that there's not anyone manipulating price, And so that's got to be a key thing. But I honestly believe that foreign investors are not here to hurt our markets. They're not here to exploit a small market by becoming aggressive and pushing a market in a particular direction. But it is to free the market so that both speculation, hedging, investment, arbitrage, all of those activities can happen without any need to be concerned that one of those activities are going to distort the market. Remember, when we speak about speculators, I think it's important to recognize that we are happy to encourage speculation because speculation gives markets liquidity. What the regulators have a responsibility to do is to avoid price manipulation and to identify when there is manipulation happening in the market. And so I think the fear that regulators have that somehow when we open our markets and we free the trading in our markets and we encourage active two-way activity in our markets, that it's going to cause distortions. It's not. It's actually going to create efficiency. Albert, I think from my side, that's pretty much what I needed to speak about. I mean, I know I have a number of slides that we can still go through, and I don't know what the constraints are with regards to time. But I think what I've spoken about and covered so far has given some insight into how the markets need to develop and what we're seeing currently in our markets.
Thanks, André. I think let's go maybe to a couple of questions, and then I'm going to allow people to drop off. And then if you've got some more, maybe in repo you can share. But we've got some questions that came through, and thanks for that. And I'm gonna. There's one long question. If you can open a queue on your side, but it's actually a couple of questions within questions. It came through from Ricardo. So Ricardo is he's a friend of Andile as well. He's a trader in Mauritius at one of the big banks in Mauritius as well. And as you can see there, you can read through his question. There's a couple of questions in it, all very relevant. And I think I'm going to just allow you, I'll read and then you can maybe just, I'll show it and people can see it. You can just maybe answer. But he asks, how does the money market stimulate the economy while the liquidity improves? And then this one, what are your thoughts about a financial market entering recession with already an existing high liquidity? Next one is the yield curve is often influenced by liquidity on the market, referring to long tenors. Do you think inflation forecasts should have a better say on yields compared to liquidity? Last one is, should there be a relation between amount of securities outstanding and liquidity in circulation on a specific market? There's a lot in that, and I think that's a whole webinar on its own. So I'm maybe going to let you choose what you want to share your thoughts on just around that.
Yeah, I mean, I think one of the key things that we've seen is that despite the injection of liquidity into the money markets after the financial crisis that we experienced in 2008-9, that it isn't the only solution, and that liquidity does not necessarily mean that we're going to see economic growth. And the financial markets entering recession with already existing high liquidity, my major concern was that the liquidity injected into the markets generally was not very often used to create economic activity, but allowed people cheap access into equity markets. And I saw equity markets just continue to rise in value in the last 10 years because a lot of the liquidity that people were given through the stimulus packages was just being redirected into asset classes to generate profit. So, you know, that is a concern for me. As far as the yield curve is often influenced by liquidity on the markets, you know, the shorter end of the yield curve we're seeing being strongly influenced. And of course, people are seeing negative interest rates in a lot of developing markets. That negative interest rate environment drove people into the longer end of the yield curve. We saw a concentration of liquidity in certain countries because of the crisis that we saw in Europe with the euro. And so people looking for safe havens started to pump money into government securities. Those governments didn't really need to raise capital because there was so much liquidity coming in that we started to see long bond yields being influenced by that as well. So the shape of the yield curve really, for me, is one which is an anomaly at the moment, that people are looking to see, looking at that, how can we forecast what's going to happen going forward? Very, very difficult to say. I mean, the distortion we saw in the oil market as well recently is indicative of the uncertainty that can sometimes play out in a market that is experiencing something so unique currently that very difficult to predict where we're going. But I would say that it's uncharted. It's something that we can't say that's exactly how it should be, and it's easy to draw a conclusion from what we see, because it isn't. There are no easy answers.
Yeah, I think a lot of things at the moment we don't know if it's an anomaly, and does it really forecast the future and what the future holds? And your example of the oil market, it's a good example of that as well. Got another question here from Richard. And he says, if you have to put your investor or speculator hat on, and also given uncertainty in a global economy, would you rather put your money in developed market bonds or emerging market bonds?
I think that with the strength that we're seeing in our bond yields at the moment, and also the strength in the rand, and I mean, I'm talking about relative strength based on where the rand was 3 weeks ago and where it is now, we're seeing people pumping money into our bond market. And obviously, when foreign currency comes into a country, what it does is it strengthens the local currency. So, it's almost like if we see enough foreign investment going into the market, it will strengthen the local currency, because dollars coming in creates local currency. The demand for bonds means that bond prices go up. So as long as there's stability in the market, that foreign investors are earning decent returns by pumping their money into emerging or developing markets, because there's no real yield for them in the other markets. I mean, there's security or safety in buying dollar securities or AAAs in Europe or in the Scandies, but you're not getting a return. So people are looking at the emerging markets as where there's real yield, and as long as there's good settlement, as long as we can see the brokers drawing people into those markets, because that's what happened. I mean, if you look at the Ghanaian, the Zambian, the Kenyan markets, the brokers have been a catalyst in bringing people into those markets, through training, through showing prices, through encouraging the local institutions. So I would say not with anything other than past experience, a lot of people see value in investing in the developing or emerging markets.
Yeah. It was interesting. André, thank you very much. I think today was a really insightful session. I can just, from our experience in implementing and in the markets, or implementing financial market systems in Africa, just your comment around a credible yield curve. We've so often seen it, where you have to implement a system and then you start talking around the curves, and how do you actually get to these curves, and just availability of data. And it's been something that I think there's opportunity there, like you mentioned, through technology. It's not difficult to be able to get those market participants all together and generate these markets in Africa, where we can create that transparency, can create credible yield curves. And I think, like you mentioned, we had a discussion last time as well. If you look at your typical American investor coming into Africa, there's only one thing he really asks, is to see what does that price trade. And if we can get that credibility, I think it will be amazing for us. Closing thoughts from your side, just before we end off, André.
Yeah, I think the key thing is the people that are the early entrants into these markets as foreign investors, those that have taken the time and effort to analyze the risks inherent in putting their money in our markets, they're the ones that are reaping the benefits. And I think I think that there's real opportunity where new markets are opening up in the Middle East, that the opportunity for people to generate real returns way above what they're earning in their own hard currencies is possible. So a vibrant bond market in sub-Saharan and North Africa is going to attract a lot of investment.
Yeah, well, thank you very much, André. Thank you very much for joining us today. If you have any questions, if you have any for us at Axiom, please email us at axiom@andilesolutions.com. André, like mentioned before, he does training like this all over the world and all over the continent. If you want to get in contact with André, please email us and we'll put you in contact with André as well. Then next up, the 24th of June will be our next Axiom session. We will have the CEO, Andries Brink of Andile, speaking to Pieter Brewer. So Pieter is in the media market or media in South Africa. So it's going to be a different type of discussion about talking about clearing out the newsroom, top stories and trade-offs. We are so inundated by fake news these days and what is true, what is not. So in this discussion, we're just going to have an open forum to just talk around, well, what does the newsroom look today? What does the media look today? And what are the top stories and trade-offs? So join us on the 24th. Thank you very much for joining us. André, thank you very much for your time. And have a great day, everyone. Thank you.